discuss government grant, Ind AS 20. So, government grant is assistance provided by the government by transfer of resources in cash or in kind. In resource transfer, entity will fulfill certain conditions in the past or in future. Example: R&D funding, grant of land, grant of PPE, uh, interest-free loan or subsidized loan. It is a transfer of resource whether in cash or in kind. Uh, Certain transactions are not to be recognized as government grant as they are government assistance or other benefits. Government assistance. It is if the government is giving assistance for which the government is not reasonably government is not reasonably valued. Example: some technical advice or marketing advice, as this would be government assistance. Uh, other benefits. Uh, Other benefits would be in the nature of, let's say for example, if the benefit is not directly provided and is for general trading benefits. Example: development of roads, infrastructure, power, all this would be other benefits. So, as per Ind AS 20, for government grant there is accounting plus disclosure. In government assistance there is only disclosure. In other benefits there is no accounting, no disclosure. Government grants. So, what are the types of government grant? It is the capital grant or a revenue grant. Capital grant is a grant for acquisition of an asset. Example: PPE, purchase, construction, or acquire long-term assets. A revenue grant is related to not related to acquisition of asset. Example: generate employment for 200 people, then would give 20% of the payroll cost. Earthquake suffered losses and government gives grant to industries which have suffered losses. Losses in industry in the past, hence government grant is given. Forgivable loan is in the nature of government grant. Under has given if the government has given a loan and waived off the loan, it is in the nature of government grant. Example: loan given to private sector and government has waived off the same, or farm loan waiver. It is in the nature of government grant. If 100 rupees loan was taken and 30 is paid and 70 is waived off, 70 would be in the nature of government grant. Recognition of government grants. When to recognize government grant? On once a reasonable assurance is there that the entity would comply with the conditions of the grant, or the grant would be received. Reasonable assurance is a matter of judgment. Sufficient degree of certainty more than 50%. Recognition and P&L income on systematic basis and to match with other related costs. Example: payroll costs 100, 30% government grant, 30 to be recognized. Year 2, 200, then 30%, 60 to be recognized. Acquisition of assets, PPE, recognized over the useful life of the asset, matching with the depreciation. So PPE has a 5-year life. Rupees 100 is the cost. 20 is the depreciation. So government grant will be recognized over 5-year life. Government grant. Uh, Grant of income, past obligation, losses, earthquake, recognized in the P&L immediately when it becomes receivable. Future obligations, income like employment related given, matching concept is to be recognized in the period in which the costs are related. Presentation of government grant. PPE life is 5 years. Two options: gross basis or net basis. Cost of PPE is 100, government grant is 20. Uh, gross basis is recognized asset of 100 and government grant of 20. Net basis is asset of 100 less government grant of 20. 80 would be recognized as an asset. There's an accounting policy choice. Income grant, no conditions attached. 100% the grant is to be recognized as and when it becomes receivable. Uh, in revenue grant also there are two options, whether to recognize on a gross basis or net basis. P&L payroll cost 100, other income 30, net basis payroll cost 100 minus government grant 30, net payroll cost 70. Government grant to related to asset cost of PPE is 120 million. Uh, and government grant is 30 million, and it has a 15-year life. So equipment account debit uh, 1 120, to bank 90, to deferred grant 30, deferred grant to other income 30 divided by 15, that is 2 per year. Deferred grant account debit to other income in year 1, deferred grant account debit to other income in year 2, and so on and so forth. Depreciation would be 120 divided by 15, that is 8 per annum. Uh, and net basis would be PPE 120 minus 30, that is 90 million. 90 million divided by 15, that is 6. Depreciation would be 6 million per year. So whether it is gross basis or net basis, the amount of debit to the P&L would be same. That is 6 million. In gross basis, opening WDV 120, uh, depreciation 8, uh, closing WDV 112, 112, less depreciation 8, closing WDV 104, 104 less depreciation 8, closing WDV 96, 96 less depreciation 8, closing WDV 88, and so on and so forth till 120 is the amount charged to the PNL. Uh, uh, Deferred grant to other income would be 30 minus 2, 28, 28 minus 2, 26, 26 minus 2, 24, 24 minus 2, 22 till 30 is utilized in P&L. So net debit to the P&L would be 6. This is gross basis, and net basis would be opening WW 90 less depreciation 6 84, 84 less depreciation 6 78, 78 less depreciation 6 72, 72 less depreciation 6 66. So debit to the P&L would be 6. In both the cases, debit to the P&L would be 6 per year. If the depreciation is charged on WDV, if the depreciation is charged on WDV, the government grant would also be proportionate. Government grant is to compensate for government grant to compensate for income. Corporate receives a grant of rupees 10 million to meet the expenses for environmental promotion, 4 million per year, and next 3 years is 5 million for 2 years. So costs are 4 million for the first 3 years and 5 million for the next 2 years. So total is 22. So 4 divided by 22, and the government grant is 10 million. 4 divided by 22 into 10, that is 1.82. 4 divided by 22 into 10, 1.82. 4 divided by 22 into 10, 1.82. 5 divided by 22 into 10, 2.27. 5 divided by 22 into 10, 2.27. So this would be gross basis, and net basis would be 10 minus 1.82, 8.18, uh, uh, 8.18 minus 1.8 to 6.36 and so on and so forth till it becomes 0. And net basis would be 4 minus 4 minus 1.82, that is 2.28 in year 1, 4 minus 1.82, 2.28 in year 2, and so on and so forth. Uh, so for forgivable loan, forgivable loans below market rate of interest is also a government grant accounting for forgivable loans when there is reasonable assurance that the entity meets the conditions. A term loan waiver for loan up to 5 lakhs. Loans would be waived off if you have paid 50% of the outstanding, immediately recognized in the P&L in the other income. City Corp got a loan, a waiver amounting to rupees 30% of the term loan. The term loan is 100 million. 100 million was taken on 1st April 2012 from the scheduled bank, and the amortized cost of the loan is also 100 million. Under the loan waiver scheme, the government would pay the bank directly. A forgivable loan is recognized in the P&L in the period in which the loan is forgiven. Term loan account debit to other income 30. Loan is given below market rate of interest. Loan is given below market rate of interest. Market rate of interest is 10%. Government grant is 2%, and the amount charged is 8%. Example: CT Corp uh, has been granted 5% government loan amounting to rupees 2,000 at the beginning of the year 1 with the prevailing market interest rate at 10%. The term loan is for 5 years and is to be prepaid as a bullet payment by the end of the term. Assume that the reporting date is 31st December of every year. Measure the government grant present to the loan and show how the loan will be recognized. Amount of loan is 2000. Interest rate for loan is 5% and market interest rate is 10%. Bullet repayment at the end of the year 5 and 5% is the amount of government grant. So 5% of 2000 is 100 million. So in year 1, there will be an outflow of 100 million. In year 2, there will be an outflow of 100 million. In year 3, there will be an outflow of 100 million. In year 4, there will be an outflow of 100 million. In year 5, there will be an outflow of 100 million plus 2000. So year 1, 100, 100, 100, year 4, 100, and in year 5, 2100 into present value factor 1.110 raised to the 1 divided by 1.10 raised to power of 1 raised to power of 2 raised to power of 3 raised to power of 4 raised to power of 5. So that amounts to 1621, 1621, and the amount of repayment is 2000 at the year at the end of the tenure. So 2000 minus 1621, 379 is the amount of government grant. Bank account debit 2000 to loan 1621 to deferred income grant 379. Opening value 1621, fair market value 10% of this 162, cash interest cost 100, 1683 is the closing balance amortized value, 1683, 168 is the amount of market rate of interest, cash interest is 100, and 1751 is the amortized cost. 1751, 175 is the amount of market rate of interest, 100 is the cash interest, and 1826, and so on and so forth till 2000 is expired. In this, the finance cost account debit would be 162, to bank 100, to loan 62, to loan 62. Fair value 162, 100 and 62. De- deferred income, deferred income to other income 62 and 68, 65 in year 2, year 3, year 4 and year 5. So interest cost would be 879, other income would be 379, net impact on P&L would be 500. Repayment of government grant, you are not able to meet the conditions and government grant becomes repayable. So let's say, for example, in the first example of 120 crores, wherein gross basis was used, and the amount of deferred grant is 20 at the end of year 5, and it is to be repaid back. So deferred grant account debit 20, P&L account debit 10, to bank 30. Cost of the asset is 100. Government subsidy is 25% to 50. Uh, uh, and certain conditions over the on meeting of certain conditions over the next 3 years, the estimated useful life is 5 years, and the entity follows straight line method of depreciation. The company uses net basis for government grant. The entity failed to comply the conditions of the government grant at the end of year 2, and the government grant becomes payable. So PPE, the entry would be PPE to bank. First entry would be PPE to bank 250 as it is accounted on net basis. And opening WDV would be 750. Depreciation would be 150. 600 would be closing WDV. 600 in year 2. 150. 450 would be the closing WDV. Uh, uh, Opening WDV without government grant 1000, 200 would be the depreciation, and 800 would be the cost. 800 minus 200, 600 would be the closing WDV if gross basis is used. So incremental depreciation would be in gross basis versus net basis 50 per year. So depreciation account debit to PPE 100 would be accounted for each of the years 1 and 2. So the PPE would be 450, which is this figure, plus 250, which is the amount accounting entry passed over here, PPE to bank, minus 100, the additional depreciation. So 600 would be the closing value of the PPE. So to the extent of government grant, uh, transfer the value of PPE to the amount charged. In case it is related to income, then uh, then 4.55 is the amount of deferred grant. Deferred grant account debit 4.55, P&L account debit 5.45, to bank 10. Disclose the accounting policy, gross basis or net basis, and nature and extent of government grant, uh, and the defined conditions. This brings us to the end of the session. Thank you so much. Please do like, subscribe the channel. Thank you.